Today I'm going to show you a stock trading secret that a lot of people don't really understand. They think they do, but I've got a surprise for you here about trading volume and how it can be very deceiving. So, going against the grain, let's check it out in just 1 second. As you can see here, OBV on balanced volume, no period. All right, so a lot of people ask me that kind of question here. So a couple of ways to do this. Now, basically, of course, what we want to do is say, well, how do we trade this puppy dog? And that is where the bottom line comes in. So one of the things that people do is they just look for it to confirm price. And so when basically price is moving up, they want to see that it is supported by volume moving up as well. And then they say, great, that's a strong trend, has good volume behind it. And okay, that's one way to do it. Actually, as far as I understand it, though, one of the concepts behind this was with Joe Granville, when he created it, was based on the idea that volume can not only confirm price action, but can lead price action. And you hear that a lot, that volume leads price. Is that really true? Well, like most things in trading, sometimes it is, sometimes it isn't. That's my opinion. You can have various opinions. Feel free to type in your opinions into the comments below. Love to hear them. But if that's true, then one of the things that we would use for reading this would be divergences. So it just makes sense that if volume precedes price, then we would be looking for divergences. So here we have equal highs on price. Here we got a lower high on volume. And so in this case, it does indeed seem to help with that, except then it's, at that point in time, you would say we have a divergence, but then OBV continues to go up while price is going down. So it's like, well, wait a minute, whoops, stay daisy at that snapshot in time on the hard edge of the screen. Looks pretty good, except then price continued to go down and OBV went up. Not so bueno, right? Not so bueno. That one didn't help us too much. What about over here? Well, let's see. We got to find another good example of that, where there would be a leading indication. Oh, here we go. So here we do have a divergence where price, this is a very small one, price is going up, and OBV is making a lower high. Okay, cool. So we found one. But one instance, and a $20 bill would get you half a cup of coffee with a homeopathic amount of caffeine at your local coffee shop. So that's not worth a whole heck of a lot, right? We found one. Great. Yay. Okay. Now, this is not a divergence, but maybe a convergence, and that would be back to confirming. So not really a divergence. We're back to the original concept of maybe just confirming price. And then it comes down, and I got to tell you, my friends, I don't see a lot of situations where these divergences happen. So I'm not a big fan of that. All right, now we've got another option here. Notice that the indicator is very choppy, right? Very choppy. Makes it hard to read, and especially you can get real myopic with these little divergences, looking at every little angle up, every little angle down. It's going to drive you crazy, and that's not going to help your trading. So here's another option for you, and that is to add a moving average to this to smooth out this choppiness. All right, voila, there we go. So now we have a moving average, and this seems a little slow to me, but you notice that it does smooth out the choppiness of the indicator. So here we could look at, well, I've got the 20-period simple moving average on here, 20 simple moving average. Obviously, you can test different moving averages. I don't think there's anything magical about using a 20-period simple moving average on this. I've tried 14. If you try real fast ones, you're going to find that the OBV goes above and below it a lot, and I don't think that's really very helpful. It's going to give you a lot of potentially false signals. So 14 is the shortest that I have found that I found somewhat useful. I got a 20 on here just because a lot of people use it. Test it out for yourself, see what you like. But anyway, here's the general concept with this. So again, it smooths it out. So again, this is not for really a divergence, although you might find some of those as well, but it's more for confirming the move up. Is it moving up on strength? Is it moving up on volume? As long as it hangs here above the 20 period simple moving average, then we would say, yeah, okay, it's confirmed with volume. Now, like any indicator, there's going to be times where it's not going to be so helpful. So here it breaks below. If you would have taken that short, you would have been in a little bit of trouble. Comes back above here, comes back above the 20, but then it goes back down below, and then we've got nothing but net. All right, but during this period of time, not some great signals. Now, if you used, again, a shorter term moving average, like a 14 or a 9, people always tend to want to use faster indicators because they think it gives them faster entries and faster triggers and faster signals. Well, they do. The problem is they're choppier as well. And so even though you get a faster signal, that signal might not be right and it could be very choppy. That's the give and take of using faster indicators versus slower indicators where this smooths it out. So you could even wait to avoid some of this. You could just go with the slope of the line and say, well, I'm just going to wait for the line to start sloping back down on the OBV and then get in. Now, the sacrifice there, of course, is me probably going to be getting in late because the nature of any moving average is it smooths price action quite a bit and is going to be a bit lagging, but more accurate. And that's another give and take in the market. Are you going to look for something faster that's less accurate or something slower that's more accurate? Get in a little later, but got a little more accuracy to it. But no matter what you do, no matter what intervals that you use and all that kind of stuff, there's going to be some point at which it doesn't work for you. This is why when people try to over-optimize moving averages, indicators, all this kind of stuff, there'll be times when it works better than another input, and then other times when it doesn't work as well as another input. There's no one optimization of any indicator or moving average or whatever that's going to work the best all the time. You are going to get false signals. Just live with it, accept it. That's what money management is for. That's what risk management is for. All right, so here we get above it, and if you went long, looking good, but always make sure you're still watching your price action. We have resistance here. So price is very important. Everyone and his parakeet is seeing that resistance level. And so even though, we get some strength coming in with volume here, and that's all well and good, but not enough. And then it turns over. So it doesn't necessarily mean it's a long-term signal. In other words, watch for the OBV and the moving average to come together and just kind of hover together like that, and for the moving average to go sideways. That's a pretty darn indication that the market is just consolidating and moving sideways there too. And finally, don't get overly optimistic about a move out of that. Here, OBV starts angling down, OBV gets below the moving average, but how long is that going to last? Doesn't mean it's going to last forever. Doesn't mean you're going into a major trend. Remember, markets only trend roughly 20% of the time. So therefore, when you do take a trade, well, what I always do is I always take a bit of profits at the first cycle low when I'm going short or at the first cycle high when I'm going long. I'm looking for one impulse move, only one impulse move, and then I lock in some profits. And that way I've got some money in my pocket. I'm using a trailing stop. The amount of money I have left in the trade is less, so even if I get stepped out, I'm not getting stepped out with nearly as much money. So this is money management, this is risk management, and that is critically important in addition to having 5 uncorrelated variables. This is why, it really bothers me when people watch one of my videos here and they say, oh, great, and they think it's a whole trading system. No way. It's an indicator. We're analyzing one thing at a time. You have to take several of these things, put them together, and create a trading methodology along with risk management, along with money management, which, by the way, are related but not identical. And then self-management. And that needs to be a part of your system as well. How do you manage yourself, your psychology? Put that all together, and now you got a trading methodology that can make you money over time. And again, you will still have some drawdowns, but if you stick with it and it's consistent and it has some logic to it as to why it will continue to work, then you can make some money. So don't look for shortcuts and don't put too much faith in any one thing. So that's it for today. By the way, if you want to learn one of my trade strategies where I show you all the rules for it and so forth, put them all together for you. Let's get you making some money before you start spending money. It's called my rubber band trade. I give it away absolutely free to all the people who watch my free videos, and gives you an example of how you put together these uncorrelated variables. I share everything with you about it so that hopefully my intention is you start making some money with that. And it's absolutely free. So check it out at rubberbandtrade.com. And again, my gift to you. So, also, if you're interested in my cycle indicator, which measures cycle highs, cycle lows, nails precise entries, go get that as well. So I would appreciate your comments. Leave them below. And happy trades, my friends.